Welcome to Cash Flow and Tell, the podcast that uncovers answers to your toughest questions about growing your business from a working capital perspective. Hosted by the people of FundThrough, we dive into real stories and lessons from CEOs, finance pros, and business owners just like you. Today, we're covering the truth behind the invoice payment gap, why it exists, how it hurts small businesses, and the momentum that's finally building to change it. Now, here's your host, JC Mattos, Chief Operating Officer at FundThrough.
Imagine this. You're the owner of a small manufacturing company. Late one evening, you get an email confirming the biggest order in your company's history, a game-changing contract that could double your revenue this year. This is the kind of opportunity every business owner dreams about. But as the initial excitement fades, a new feeling creeps in: anxiety. Why? Because to fulfill that massive order, you must pay for raw materials, hire additional staff, ramp up your production now, while your customer will not be paying you for 60, 90, sometimes 120 days. Your bank isn't keen on extending that loan agreement for a purchase order, and your cash reserves are nowhere near what's needed. In that moment, what should be a victory can start to feel like a looming catastrophe. You're not alone. This scenario of success turning into stress because of a slow cash flow plays out for countless small and medium-sized businesses across different industries. Whether you're in manufacturing, retail, energy, oil and gas, logistics, professional services, one truth spans all these fields. Cash flow is the fuel for your growth. You can have a full pipeline of orders and a calendar of projects, but if you don't have cash flowing at the right time, your growth engine sputters. Here's a hard fact. 82% of small businesses' failures are due to cash flow problems. Let that sink in for a moment. It's not a lack of profits or a lack of customers, but a lack of ready cash that ends most businesses. In B2B industries, waiting to get paid is practically a way of life. The median payment cycle is 56 days across sectors. That's almost 2 months from the time you bill until the time you actually get paid. And in some sectors, it's even longer. Consulting firms, as an example, and facility service providers often operate on 60, 90, 120 days. Meanwhile, your expenses can't wait. Employees expect their paychecks every 2 weeks. Suppliers want to be paid on delivery. Rent and utilities are due at month end. The result is a pressure cooker of obligations that can explode if not managed perfectly. I'm JC Mattos, and over the next 20 or 25 minutes, I'm going to unpack why mastering your cash flow is absolutely critical for scaling your business. More importantly, I'll explore how smart financing tools, specifically invoice factoring and embedded finance, can transform that cash flow crunch from a growth killer into a growth catalyst. By the end of this episode, you will see how solving cash flow challenges can empower you to seize opportunities instead of stumbling over them. To understand why cash flow is truly the fuel for growth, let's look at what happens when that fuel runs low. Across different industries, the storyline is strikingly similar, and it usually is not a happy one. Let's dive into a few real-world scenarios. Let's start with manufacturing mayhem. Meet Alice, a fictional character who owns a custom parts manufacturing shop. Business is good. She has a solid orders from clients. But her clients are mostly large equipment companies that pay net 60, net 90, meaning 60 or 90 days after you invoice. Last quarter, Alice paid for thousands of dollars in steel, electronics, and labor to deliver a very big project. She won't see a dime from those projects for weeks, even months. Meanwhile, payroll is due next week, and her steel supplier is asking for payment upon delivery for the next batch of materials. Alice jokes that she feels like a bank. Money keeps leaving her hands and takes ages to return. It's a balancing act on tightrope. One misstep and a late customer payment could mean she can't payroll and take that next order. Far from being able to focus on growth, Alice is stuck juggling bills and praying every month. Next, let's look at the oil and gas tightrope. In the oil and gas industry, long payment terms are the norm. If you're a service provider or supplier to a big energy company, you're probably nodding your head right now. It's common to agree that 60, 90, 120-day terms are in contracts. In recent times, even those terms have been stretched even further. When analysis showed that oil and gas suppliers were getting paid on average 20 days past the agreed terms in 95% of transactions. Think about that. If your contract said net 60, you might actually be waiting 83 days to see the cash. Some large oil companies have been pushing payments a full month beyond the terms since the pandemic. Now, put yourself in the shoes of a small oil field service firm. You have to pay your crew, rent your equipment, buy fuel and parts, everything now, but your invoice for that drilling job won't be paid for nearly 3 months, and maybe longer if the client stalls. It's no surprise that many service providers feel the cash crunch that makes it difficult to payroll, buy new equipment, and fund the next project. And the result? Companies start turning down jobs and prioritizing bigger clients who pay faster, leaving growth on the table. Then there is a logistics logjam. Next, consider a trucking company. Let's call it Speedy Transports, a regional freight carrier. Speedy trucks are always on the move, delivering loads of manufacturers and retailers. The work is there, the miles are being driven, and here's the catch. In trucking, brokers and shippers often pay in 30, 45, or 60 days after a load is delivered. Fuel for trucks, however, must be paid upfront, and drivers need their wages every week. Maintenance bills for broken down rigs can't wait 2 months either. The owner of Speedy Transports will tell you, we can have a great haul this month and still be broke waiting for payments. In fact, it's widely known in the freight industry that cash flow can make or break a carrier. There are over 2 million trucking companies in the US, mostly small fleets, and many of them rely on invoice factoring just to survive those 30 to 90-day waits. We'll talk more about factoring in a moment. One major freight broker reported that over 75% of their small carrier partners use invoice factoring to get paid faster. Otherwise, they simply couldn't cover fuel, insurance, and trucking payments in the interim. To put it bluntly, if a trucking company cannot bridge that cash flow gap, its trucks stop rolling, and a parked truck means no revenue at all. And finally, consider this professional services pinch. Let's talk about consulting and professional services firms. Engineers, consultants, marketing agencies, law firms. These businesses often deal with big clients, perhaps Fortune 500 companies or government agencies. Big clients have big demands, including extended payment terms. It's not unusual for a consulting of a large client to insist on net 60 or net 90 terms. So you deliver a project in January, but you might not see that cash coming until March or even April. And meanwhile, your employees and subcontractors, the talented people who actually deliver the work, are expected to be paid twice a month. In one consulting firm, the leadership realized that they were frequently scrambling to pay contractors on time because of those delays. It was damaging their reputation. Words spreads quickly in tight-knit professional networks if you pay late. Take this quote from their CEO. Before controlling our cash flow, we lost several excellent contractors because of payment delays. It took months to rebuild those relationships. One business owner admitted, and even more painful, lack of ready cash can mean turning down dream projects. Imagine having to say not now to a lucrative contract because you can't afford to hire the need of talent. That happened to another consulting firm owner who said, we had to pass on a major contract last year because we didn't have the cash buffer to bring on the necessary specialists. In short, slow cash flow doesn't just strain your finances. It hurts your credibility, your opportunities, and your team's morale. So what do all these scenarios have in common? In each case, the business is doing everything right on paper. They have customers, they have revenue, they have growth opportunities, but their working capital, the cash to run the day-to-day operations, is locked up in account receivables. They're unpaid invoices. Or maybe an inventory is waiting to be sold. Growth requires fuel, and in business, fuel is cash. When you run out of it, growth stalls, and in worst cases, it's not just growth stalls. The whole business can come crashing down. Remember that 82 is statistic. More than 8 in 10 businesses that fail aren't defeated by the market or competition. They run out of cash and flatline. Even profitable companies do go bankrupt if they can't pay their bills in the short term. It's like a car with a powerful engine but no gasoline in the tank. It doesn't matter if it's a Ferrari or a pickup truck. Without fuel, it's not going anywhere. Now, this is the point in our story where things could sound pretty bleak. But stick with me, because next I'm going to shift from problem to a solution. And it's a solution that smart, savvy small businesses are increasingly using to turn their tables on cash flow. Let's introduce the hero of the second half of our episode, invoice factoring. If cash flow is the fuel for growth, then invoice factoring is like a fuel truck that can refill your tank on demand. It's not magic, it's finance. But when used correctly, it can feel pretty magical in how it unlocks capital that was otherwise stuck in limbo. So, what is invoice factoring? In plain English, invoice factoring lets you turn your pending invoices into immediate cash. Instead of waiting for your customer to pay, you sell that invoice to a factoring company, often just called a factor. Then the factor pays you most of that invoice amount right now, and then they wait for the customer to pay them on your behalf. You get your money up front, minus a small fee, and the factoring takes on the weight and the work of collecting from your customer. Let's break down that process step by step, because it's important to see how simple it is. You deliver your product or service. You've done the work, shipped the goods, completed the project, and you issue an invoice to your customer payable, say, in 60 days. You sell that invoice to a factoring company. The factoring company looks at that invoice and often the creditworthiness of your customer and agrees to purchase that invoice from you. Typically, they will advance around 80 to 95% of that invoice value immediately. For example, a $100,000 invoice, you might get $85,000, maybe $95,000 wired to your bank account within hours. Your customer then pays the factor later on. At the end of the 60 or 90 day, or whatever your terms are, your customer pays the $100,000, but that payment goes to the factor. Then the factor sends you the remaining balance, let's say the last 5 or 15%, which they held in reserves, minus their fee. The fee might be a few percent of the invoice value. In our example, perhaps the factor fee is $2,000. They would give you the remaining $15,000 minus $2,000, equaling $13,000. In total, you got $98,000 on a $100,000 invoice, and you got most of it right away when you needed it most. That's it. No new debt, no long-term loan agreements, no waiting. You've effectively transformed the promise of future cash into cash in hand today. And most importantly, you didn't have to chase the customer for payment. The factor takes on that collection process as part of their service. Your customer might not even notice anything different except sending the payment to a financing company's address. You continue your business as usual, offering the same credit terms to your customers, but you're getting paid almost as if everyone paid you upon receipt. Now, let's address a few key points about factoring, because I know what some of you are thinking. This sounds great, but what's the catch? Or, isn't factoring expensive? Those are all very fair questions. First, yes, factoring comes at a cost. Factors charge a fee, essentially a discount on the invoice, which can range from maybe 1% to 4% or more, depending on the length of the term and the risk associated with it. So factoring is not a free money. However, smart businesses weight that fee against the benefits. If paying a 2% fee gets you cash now that you can turn into 20% profit growth, or it lets you avoid missing a critical deadline and opportunities, it's well worth it. Think of factoring fees as the cost of speed and flexibility. Just like you might pay a little extra for overnight shipping instead of a standard mail, you're paying for faster cash flow. Many companies gladly absorb that small margin hit to ensure operations run smoothly and opportunities can be seized. Secondly, invoice factoring is not a loan. This is a crucial distinction. You're not borrowing money that you have to pay back later with interest. You're selling an asset, in this case the invoice, for an upfront price. This means there's no debt added to your balance sheet. You're not incurring monthly repayment obligations or pledging collateral in that same way as a loan. In fact, one of the beauties of factoring is that the financing is based on your customer's credit and payment reliability, not yours. If you have solid customers with good track records, a factoring company will be willing to advance on those invoices even if your own credit history is thin or your business is very new. That makes factoring especially useful for small and medium-sized businesses or startups that don't have a long credit history or assets to pledge. Traditional banks might turn them away, but factors will step in as long as the invoices are reputable buyers. Third, factoring can actually reduce your administrative burden. Handling collections and account receivables can eat up a lot of time. The factoring company often takes over the task of sending reminders and collecting from your customers directly. They're motivated to get paid, after all. That frees you and your team to focus on production, on sales, and delivering the great service or product, not playing the debt collector. Some factors also offer helpful services like credit checks on potential customers, so you don't do business with bad risks, and even handling invoicing processes end to end. In the trucking example that I mentioned earlier, many freight factoring companies bundle in services like handling all the billing paperwork, providing fuel cards, and more, essentially becoming an outsourced back office for small carriers. No wonder invoice factoring has become increasingly common in certain industries. It's not some niche, last-ditch resort. It's a mainstream financial tool. In fact, the global factoring market is enormous, on the order of trillions of dollars in transactions per year. Yes, trillions with a T, as businesses of all sizes take advantage of it. To bring it closer to home, in the US trucking industry alone, factoring companies purchase around $90 billion worth of invoices every year. And remember, these are mostly small companies factoring their freight bills. In the oil and gas sector, factoring has quickly gained traction as well. What used to be an uncommon practice is now a standard operating procedure for many suppliers and contractors looking to survive and grow in a world of delayed payments. Why? Because it works. It injects liquidity where there was none. It unlocks capital that you've earned but haven't yet received. Let's revisit our earlier stories now. With this new tool in hand, think of Alice, the manufacturer terrified of taking that giant order. Instead of panicking about cash, Alice contacts a reputable factoring company. She makes the sale, delivers the product, and then factors the invoice. Within a few hours of shipping her order, 85, maybe even more, of their invoice value is sitting in her bank account. Tens of thousands of dollars that she can use to pay her suppliers and her team right now. She doesn't have to beg the bank for a short-term loan or dip into an emergency fund, even if she has one. She fulfills that order and even has cash left to invest in a new piece of equipment she's been eyeing. When the client's check finally arrives 2 months later, it goes to the factor, who then sends Alice the remainder of the money minus their small fee. Alice's margins were a bit lower on that order due to the factoring, but guess what? She pulled it off. The big contract is delivered, the client is happy, and her company is now on the map for even larger opportunities. Growth fueled. How about our oilfield service provider struggling with a 90-day term? Using invoice factoring, they can get paid in days, in hours, instead of months for each completed milestones. That means they have the cash to pay the rig crews on time, keep their trucks fueled, and rent the additional bulldozer for the next project. In fact, many upstream oilfield services companies have made factoring an integral part of their growth strategy, not just as an emergency option. By factoring invoices regularly, they ensure they always have working capital on hand to bid on the next big job, to take on additional projects when opportunities knock, and to scale up when the industry is booming. One oilfield contractor was able to take on an extra pipeline project, one that would have normally been out of reach, because factoring provided the upfront cash to mobilize the crews and equipment for that project. Without factoring, they would have had to decline that project or delay it, and maybe the opportunity would vanish. With factoring, they said, yes, I can start right away. And it paid off in a big expansion of their business. For Speedy Transports, our trucking company, factoring their freight bills means no more waiting for 45 days to get paid for a delivery. Instead, an invoice is submitted to the factoring partner to the same day, the load is delivered, and by the next day, most of that cash is in the bank. Speedy can pay for fuel, pay for their drivers, and keep on trucking without missing a beat. It smooths out the cash flow so effectively that the owner can actually sleep at night. She knows that even if one customer is slow to pay or there is an unexpected repair bill, the constant inflow of factored cash will cover their gaps. This flexibility helps small carriers survive in a tough industry. Factoring fills a void left by banks, giving these businesses elasticity to expand when freight demand surges and to hang on when the market slows. It's no exaggeration to say that for many logistics companies, factoring is the difference between growth and going under. And our consulting firm, friends, how does a story change for them with factoring? Imagine finishing a big project and instead of waiting 3 months to get paid, you factor that $200,000 invoice and get $190,000 in a couple of hours. Now you can immediately bring on that next group of subcontractors for a new project without worrying about cash. You can confidently take on that dream contract because you know you'll have the funds to cover the upfront costs. Your contractors are happy because you pay them on time or even early, and your team isn't stressed about cash flow, and your reputation soars as a firm that can handle big jobs and projects without financial hiccups. One consulting firm that fixed their cash flow noted that after doing so, they landed 3 new major clients, partially because the owners could focus on building relationships instead of constantly juggling finances. That's the kind of real, tangible growth that happens when you remove the cash flow handcuffs. By now, hopefully, you're seeing a pattern. Invoice factoring can turn the cash flow crunch from a barrier into a springboard. Instead of strangling your growth, steady cash flow unlocks it and gives you the agility. It gives you the confidence to pursue opportunities and the ability to weather surprises. But our episode doesn't end here yet, because the story gets even better. And why? 2 words: embedded finance. Technology and innovation are making tools like invoice factoring easier, faster, and more seamlessly integrated into your business than ever before. In the next part of this podcast, I'll explore how the future, which is already arriving, is bringing financing solutions right into the platforms and software small and mid-sized businesses use every day. It's the next evolution in unlocking capital. Up to now, we've been talking about the traditional invoice factoring, which usually involves a dedicated factoring company and some agreements and processes to set it up. Now, imagine if accessing something like this factoring was as easy as clicking a button in the software you already use to run your business. That's where embedded finance comes in, and it's poised to be a game changer for small and mid-sized businesses' cash flow. Embedded finance is a buzzword, but what it means is straightforward. It's about integrating financial services into non-financial businesses or platforms. Instead of sending you to a bank or a lender's website, the financial service is offered to you in context, right where you already are conducting business. We see it around us as consumers. When you're on an e-commerce site and it offers you an installment plan at checkout, like buy now, pay later, that's an embedded lending. When you use a rideshare app and it has its own payment system and offers drivers a way to cash out their earnings instantly, that's embedded finance in action on that platform. The idea is to remove friction and meet users where they are. For businesses, embedded finance can take many forms: integrated payments, on-platform banking accounts, insurance offerings, and yes, even embedded lending and invoice factoring. The goal is to let the businesses manage their money and access capital within the same systems that they use to do the work, whether that's an accounting software, an online marketplace, or an industry-specific app. How does this relate to invoice factoring and cash flow? Great question. Embedded invoicing factoring is an emerging trend that is reshaping how businesses get funding. It means the ability to get an advance on your invoices is built in directly into that platform you use. For example, say you use an online marketplace to sell your products B2B, or you use invoice software like QuickBooks or Xero. With embedded finance capabilities, that software might have a feature that says, "Need this invoice paid right now? Click here." And boom, you click a button, and behind the scenes, the platform either uses its own capital or partners with a factoring provider to advance you that cash. You didn't have to go out and find out a factor yourself. The service came to you at the exact point you needed. Consider this real-world shift. Major SaaS companies and financial tech platforms have begun rolling out features like embedded invoicing financing specifically to help small businesses users smooth out their cash flow. Intuit's QuickBooks, for instance, offers QuickBooks Capital, where eligible users can get advances on invoices or short-term loans within the QuickBooks interface. Companies like Stripe and Square, which many businesses use for payments, now offer instant payouts and funding based on your receivables, all integrated in their dashboard. A vertical platform serving, say, freelance consultants might offer an integrated factoring service so that when a consultant invoices a big client through the platform, they can choose to get most of that invoice paid out immediately, minus a fee, without ever leaving the app. One fintech leader noted that with embedded finance tools, a business software can become the financial operating system for small businesses, giving them banking, payments, and lending in one place. In that vision, cash flow management becomes almost automatic. No more patchwork of different bank portals, loan applications, juggling 8 different tools. The more seamlessly these services integrate, the less downtime you have between doing work and getting paid for that work. Embedded invoice factoring carries huge benefits for small and mid-sized businesses. First, there is an instant access to cash. By leveraging embedded factoring, you get quick capital injections right when you need them. This speed can be life-saving if you're facing an unexpected expense or you want to grab a time-sensitive opportunity. It's like having a turbo boost for your cash flow, available on demand. Second, less friction, less effort. Because it's built into the software that you're already using, there's no lengthy paperwork or separate onboarding in many cases. The integration often means your data is already there, such as in invoices or sales history, etc. So the decision can be faster and often automated. Fewer hurdles mean more businesses can actually take advantage of it. Instead of saying, ugh, I don't have time to set up a financing. It's right there in front of you, easy and user-friendly. Third, you get confidence and risk management. Good embedded finance offerings will often bake in things like credit assessments of your customers. In fact, some platforms will tell you which invoices are eligible for funding immediately, which essentially means those customers are deemed creditworthy by the system. That gives you confidence to extend terms to new customers as well, knowing you can factor the invoices and not worry about whether that new customer is going to pay late or default. And manufacturing solutions, embedded or not, can be non-recourse for you, meaning if the customer doesn't pay, the factor eats that loss, though usually the fees are higher for that type. Either way, you're offloading a chunk of your credit risk to a partner, which is helpful. And finally, embedded invoice provides supporting growth and loyalty. When you get your cash faster and with less hassle, you can focus on growth. One report pointed out that by improving cash flow and reducing financial admin tasks, business can actually grow faster and engage more with the platform that's providing these services. It's a virtual cycle. You grow, so you use the platform more, and the platform benefits from having a more successful customer. That's you. No wonder so many B2B platforms are eager to add these financial features. It makes us, the users, stickier and more loyal, and it opens new revenue streams for them too. They often earn a small cut of that financing fees. It's a rare win-win-win. Good for the small and mid-sized business, good for the customers of those businesses because healthier suppliers can serve them better, and good for the software platform company. That means embedded finance is here to stay and likely to expand rapidly. In fact, experts predict that a significant chunk of small business lending will move through embedded channels in the coming years. One analysis even suggested by 2030, embedded finance could account for 25% of small and mid-sized businesses lending in some regions. The convenience factor is just too compelling. Let's make this concrete with a short example. Say you run a construction service company and you use an industry-specific project management app to handle scheduling and billing jobs. Now, imagine within that app, on the billing tab, you see an option, advance payment. Get up to 90% of your invoice paid right now. You click. The system evaluates that invoice and the client. Maybe it's integrated with a credit bureau or uses historical data. You get an offer instantly saying, advance $50,000 now at a 2% fee. The client pays in 60 days as usual. You click accept because you need that $50K to start the next phase of the project. Done. In seconds, you've solved a 60-day problem. And it all happened on the same app where you managed the project. No separate bank visits, no forms with your banks. This is not science fiction. This is literally the direction the industry is moving to. Companies like FundThrough, a fintech factoring platform, have been partnering with marketplaces and B2B platforms to embed this exact capability, so users can factor invoices from within whatever system they are already using. The future of small and mid-sized business finance is embedded, contextual, and very, very fast. What does this mean for you, the business decision maker? It means that the playing field is leveling. Techniques and financial strategies that used to require a whole finance department or fancy banking relationships are becoming accessible to the little guys and the mid-sized players. A decade ago, maybe only big companies had the clout to demand the supply chain financing or had banks offering them credit on receivables. Now, your 5 million manufacturing firm can effectively do the same thing with a few clicks thanks to fintech. As one industry voice put it, embedded finance tools can turn a patchwork of financial cores into a streamlined, growth-focused machine. You get better visibility, more control, and the precious commodity of time back on your side. We began this episode with a story of promise and peril, a huge opportunity almost slipping away because of a cash flow crunch. Now, as I wrap up, the picture looks very different. We've seen how cash flow, or lack thereof, truly dictates what's possible for your business. It can be the limiting reagent that stunts your growth, or the high-octane fuel that propels you forward. The difference lies in how you manage and unlock that cash flow. Let's go over a few key takeaways for you to apply in your business going forward. You are not powerless in the face of cash flow challenges. Tools like invoice factoring give you the ability to take control of your timing. You don't have to simply accept that money comes when it comes. Invoice factoring is a form of financing where a factor pays most of your outstanding invoice ahead of net terms, often a day, so you can focus on growing your business. Payment delays caused by net terms are not just an inconvenience. They are a leading reason for why small businesses fail, but you can take action to speed up your cash flow. Businesses across many B2B industries factor invoices to seize large contracts that will grow their business and easily manage your recurring expenses like payroll. Invoice factoring and other funding solutions are becoming part of the platforms you use every day through embedded finance. You might be able to easily factor invoices through your accounting or invoicing software. Here's the big takeaway. You are not powerless in the face of cash flow challenges. Tools like invoice factoring give you the ability to take control of your timing. You don't have to simply accept that money comes when it comes. You can actively pull the future cash into the present and use it to capitalize on opportunities, maintain stability, and invest in growth. And with the rise of embedded finance, this isn't a cumbersome process anymore. It's increasingly seamless, part of doing business in the modern world. Think back to those industries I touched on: manufacturing, oil and gas, logistics, professional services. Different businesses, different challenges, but a common thread in the solution. Find ways to accelerate your cash flow. A company with healthy cash flow can negotiate better with suppliers. Maybe they can snag early payment discounts or bulk deals. They can venture into new markets and can endure the shocks of economic ups and downs. It's the equivalent of running your machines with a full battery versus trying to operate on a 10% and low power mode. Which one is going to outperform the other? The one that is fully charged every time. Before I sign off, let's revisit our opening scenario one last time, but now with our newfound perspective. The manufacturer Alice stands at that crossroads of opportunity and anxiety. But in the version of that story, she doesn't hesitate. She knows her cash flow strategy is in place. She's arranged an invoice factoring line ahead of time, or maybe her billing software has an embedded finance option ready for her. She confidently takes the big order, negotiates perhaps even better terms with her supplier because she can pay them promptly using the factory funds, and delivers the work on time. Her team gets paid without a hiccup. The customer is impressed, and Alice's business becomes known as a reliable partner that can handle big jobs without an issue. Alice didn't gamble her company's future on hope. She leveraged that modern financing to ensure she had the capital to fuel when she needed it most. That is what unlocking capital for small and mid-sized businesses growth is all about. As I finish this episode 1, you might be feeling inspired, or maybe you're reevaluating your own business's cash situation in your head. I hope you are. Ask yourself, do I have the fuel I need for the growth I want? And if not, how will I get it? The great news is you have options and allies out there to help you. Now, here's your call to action. Take stock of your cash flow. Identify if cash crunches are holding you back from opportunities or causing you sleepless nights. Because acknowledging the problem is the first step to solving it. Then, start exploring solutions. Whether it's talking to an invoice factoring partner, checking out what financing features might already exist in the software that you're using, or simply educating your team about better cash flow management. The resources are closer at hand than ever. So, let's review a few key takeaways from what we've covered. Strong businesses still have cash flow challenges. You can have a full pipeline and a calendar packed with projects, but if all of your cash is stuck in receivables that won't get paid for months, you miss big opportunities and waste time on solving cash crunches. Moreover, invoice factoring is mainstream financing that turns tomorrow's payments into today's working capital. Factoring unlocks cash that's already yours. Instead of waiting 30, 60, or even 90 days for customers to pay you, you can access most of that money right away and put it to work, paying your team, taking new contracts, or investing in growth. Furthermore, factoring does not create debt because it's the sale of an asset. Unlike a traditional loan, factoring doesn't add liabilities to your balance sheet. You're not borrowing your money. You're selling an invoice for immediate cash. That means no repayments, no interest, and no extra debt. Just faster access to funds you've already earned. One more thing. Embedded finance is the future of small business funding. Many platforms have built financing directly into the tools you already use. From accounting software to invoicing systems, and more are coming. It's fast and automated for a seamless funding experience. And finally, take stock of your cash flow situation. If cash flow issues are causing you stress and limiting opportunities, it's time to explore solutions. Talk to an invoice factoring partner or see what financing features are available in your software. You're more empowered than ever to take control of your cash flow, to take control of your business.
Thanks for listening to Cash Flow and Tell. From all of us at FundThrough, we hope this episode got you one step closer to growing the business of your dreams. Make sure to hit that subscribe button. We'll see you next time.